Hi everyone. While 72.5 million Americans are celebrating their tiny raise from Social Security, I'm about to show you why the 2.5% cost of living adjustment for 2025 is actually crushing retirees financially. And here's what's crazy. Institutional investors figured this out months ago and have been quietly positioning themselves in a completely different strategy. I'm talking about an approach that's generating 3.82% yields right now. That's 53% more income than what Social Security offered through this COLA increase. And smart money has poured $12.3 billion into this exact strategy in just the last 12 months, while retail investors were celebrating their $50 monthly raise. Let me break down what's really happening here, because the numbers tell a story that nobody in mainstream financial media wants you to see. And with the 2026 COLA announcement coming in just days on October 15th, this situation is about to get even worse. The $50 monthly illusion that's actually costing you money. Here's the thing about the 2025 Social Security COLA on the surface. Retirees got a $50 per month raise on average. That's an extra $600 per year. Sounds decent, right? Wrong. The Senior Citizens League just confirmed their final prediction for the 2026 COLA at 2.7%, which will be officially announced October 15th, 2025. Now here's what blew my mind when I saw the data. Medicare Part B premiums are set to jump by 11.6% in 2026, increasing from $185 to $206.50 per month. That's an extra $21.5 being deducted directly from Social Security checks. Do the math. The projected 2.7% COLA gives you $54.22 monthly increase, but you lose $21.50 to Medicare. Your actual raise, just $32.72 per month. And that's before we talk about real inflation. According to the latest CPI data through September 2025, food prices up 3.2% year over year. Electricity costs surged 6.2%. Piped gas up a staggering 13.8%. Housing costs climbing faster than COLA. The projected 2.7% COLA isn't keeping pace with 4 out of the 5 biggest expense retirees face. You're not getting ahead. You're falling behind while the government tells you you're getting a raise. Here's what the smart money figured out and why you need to know this now. While retail investors are debating whether their Social Security checks will cover bills, institutional money has been flooding into high-quality dividend-paying assets at record levels. One ETF in particular has seen absolutely explosive growth despite underperforming the market. The Schwab U.S. Dividend Equity ETF, the ticker is SCHD, has attracted net inflows exceeding $12.3 billion over the past year. Why would smart money pour billions into an ETF that's only up 4.25% year to date, while the S&P 500 soars? Because they understand something most people don't. When you're living on fixed income, reliable cash flow beats capital appreciation. Every single time. Here's the data that changes everything. SCHD current metrics for October 2025. The dividend yield is 3.82%. 5-year dividend growth, 11.59% annually. Expense ratio 0.06%, that's $6 per $10,000. Assets under management $69.1 billion. Holdings 103 quality dividend champions. Now let's talk real numbers. If you have $100,000 invested in SCHD, you're generating $3,820 per year in dividend income. That's $318.33 per month, or 6.4 times what the average retiree got from their 2025 COLA increase of $50 monthly. But here's where it gets really interesting. The 11.59% secret that changes everything. Everyone's obsessed over SCHD's 4.25% year-to-date return and comparing it to the S&P 500. They're missing the entire point. SCHD's dividend has grown at 11.59% annually over the past 5 years. Let me show you what that means in real dollars. Year 1, $100,000 generates $3,820 in dividends. Year 5, same investment generates $6,435 annually, with continued 11.59% growth. That's a 68% increase in actual income over 5 years. Meanwhile, Social Security COLAs have averaged just 2.6% over the last 20 years, barely keeping pace with inflation. The Nationwide Retirement Institute released survey data in August 2025 showing that 52% of Social Security recipients have cut back on discretionary spending like travel and dining. Worse, 31% have reduced spending on essentials like groceries and medications. This isn't a future problem, it's happening right now to millions of retirees. The three-part strategy institutional investors are using. Here's what I'm seeing from institutional money flow data and what sophisticated investors are actually doing. Strategy number 1, the core income foundation, 40 to 50% allocation. SCHD becomes your base for reliable, growing dividend income. The fund holds 103 companies with at least 10 consecutive years of dividend payments, all passing strict financial quality screens. Top sector exposures include energy, 19.23%, inflation protection through Chevron, ConocoPhillips, consumer staples, 18.81%, recession-resistant via PepsiCo, Coca-Cola, healthcare, 15.53%, demographic tailwinds with AbbVie, Pfizer, financials, 20%, clinical growth opportunity. The 0.06% expense ratio means you keep 99.94% of your money working instead of paying fund managers. Strategy number 2, the dividend reinvestment accelerator. If you don't need income immediately, reinvest those dividends. Based on historical performance, a $100,000 investment in SCHD with dividends reinvested would have generated approximately $29,009 in total value over 10 years. Without reinvestment, around $25,900. That $3,109 difference is compounding, working for you instead of against you, like Social Security's declining purchasing power. Strategy number 3, the income gap closure. Use SCHD dividends to bridge the shortfall between Social Security and actual expenses. For example, monthly expenses of $3,500, but Social Security provides only $2,000. You need $1,500 monthly. That's $18,000 annually from other sources. Required investment in SCHD at 3.82% yield, $471,204. Yes, that's substantial, but this investment grows its dividend by 11.59% annually on average, while Social Security COLA averages just 2.6% over 10 years. This gap becomes massive. Why October 2025 could be your last window at these prices? SCHD currently trades at $27.04, down from its 52-week high of $29.72. That's a 9% discount, and institutional investors view this as a buying opportunity before the market rotation everyone's predicting. Here's why the window might be closing. Number 1, the growth to value rotation is coming. Multiple Wall Street analysts predict a shift from growth to value stocks as AI valuations stretch. When that rotation hits, dividend funds like SCHD typically see rapid appreciation. Number 2, rate cuts favor dividend stocks. With the Fed's cutting cycle continuing, dividend stocks become increasingly attractive relative to bonds and cash. Number 3, the demographic tsunami. 10,000 baby boomers turn 65 every day. As they transition to retirement, demand for income-producing assets will explode. Number 4, attractive valuation. SCHD's PE ratio of 16.41 sits significantly below the S&P 500's valuation, yet it holds 103 of America's biggest quality dividend payers. The action plan, what to do before October 15th. Week 1, open a brokerage account if needed. Major brokers offer commission-free ETF trading. Week 2, calculate your income gap. The difference between Social Security plus pension and actual monthly expenses. That's your target dividend income. Month 1, start your SCHD position. For large sums, consider dollar cost averaging over 3 to 6 months to reduce timing risk. Ongoing, set dividends to reinvest if you don't need immediate income. If you do need income, arrange automatic transfers when dividends pay, quarterly. March, June, September, December. The truth nobody wants to say out loud. Social Security was never designed to be your only retirement income. It was designed to supplement your savings. The 2.5% COLA for 2025 and projected 2.7% for 2026 aren't keeping pace with real inflation that retirees experience daily. You have two choices: accept declining purchasing power year after year, or take control by building an income stream that grows faster than inflation. SCHD isn't the only solution. But with $69.1 billion in assets, a 14-year track record, and institutional investors pouring in billions, it's proven to be one of the most efficient, low-cost ways to generate reliable, growing dividend income. The 2026 COLA announcement hits October 15th. The data is clear, the opportunity is now, and the choice is yours. Remember, while Social Security gives you a 2.5% raise, SCHD has been growing dividends at 11.59% annually. That's the difference between barely surviving and actually thriving in retirement. This content is for educational purposes only and does not constitute financial advice. Consult with a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. Please like, share, and subscribe. Here's to your investing success. Profitable investing.